Hello, traders. Gary Wagner here. Approximately 12:30 in Honolulu, 6:30 in New York. It is Thursday, May 13th, 2021, and this is the Daily Report for Gold and Silver. A muted recovery today, with gold gaining about $2.40, currently fixed at approximately $18.26. Of course, we pulled profits at approximately $18.16 to $19, so a little bit under this point. On today's show, we will detail the parameters we are looking at to re-enter a trade in gold. We are still long copper. That was down today. We'll talk about both of those markets in detail during the show, which begins now. After yesterday's strong decline in gold, actually taking it to an intraday low of 18.13 before recovering, and then added to today's gain of about $4, we currently have the June contract at 18.2680. It is absolutely a nice recovery, although I still find it odd that when we got inflation numbers that were so high that gold didn't react either in a tepid or neutral manner or even a bullish manner. Traders, as you know, we moved our stop to the market yesterday, exiting the trade at approximately 18.16 to 18.19, taking a small profit between $600 and $900 per COMEX contract. Reminds me of a story that was told to an interviewer from Fortune magazine by a gentleman named Herbert Hoyle. He was one of the most prominent traders, equity traders in the 50s, and the interviewer asked him, what do you attribute your success in trading stocks when so many people lose? He replied with a one-line answer: I always sell too soon. In this case, we do have the market moving higher. And as you know, I have no problems either buying the breakout or buying the dip, but this is my current analysis. It seems as though we continue to trade in a stair-step manner, and by that I mean we get a price ascent followed by a period of consolidation, then the market moves higher. Here we moved a little bit lower, but in essence we traded sideways, and then we spiked up to these highs. These highs came in almost as a rounded top. And although I believed that we would find resistance at the 200-day moving average, it came in a little bit below that. That being said, we opened at the 50% retracement level. That comes in at approximately 18.16. That's right where we got out, and it closed above that. That's a positive statement. The other thing that I'm really noticing is the alignment of the moving averages that we're looking at, because we have the 200-day on top, and that is obviously in bearish alignment, because you want the 200-day on the bottom, and then you want the shorter ones to concurrently move up. However, recently we had the 21-day exponential move above the 50-day moving average. Now it looks as though it is going to cross above the 100-day. We still need the 50-day to cross above the 100-day, but it does appear as though since we hit this double bottom, which began at the beginning of March, concluded really at the end of March, we have really seen a nice rally. And considering that the market hit that bottom of about 1670 and is now at 1826, we have had a considerable rally with really no sizable corrections. And when I say sizable, I'm looking at a 7 to 10% correction, which tells me we could clearly still be in bullish mode, although in terms of our Elliott wave count, we began our primary fifth wave on March 8th. We can see that when we look at the Elliott wave count that I have now entered onto the screen as the conclusion of a fourth wave here. Now realize, on that fifth wave, that will be composed of a series of 5 waves. Wave 1, 2, 3, 4, and 5. All of these together will be the primary fifth wave. I am simply referring to wave 1, the first of 5 waves within a major fifth wave count. And the way we look at that is we've got our 1, our 2, we've got our long third wave here, we've got our correction ABC, our fourth, and now we've got the possibility that we've hit our fifth wave. And if in fact we have concluded a fifth wave under our subcount, meaning we went from 1, 2, 3, 4, and 5, this being the first of a subcount of the primary wave, we could now easily enter a corrective wave 2, which would be something like an A, a B, a C, and then we would begin a long wave 3. So we want to be careful to see if we're going to enter some sort of corrective wave here. Right now, we know what our parameters are. We have support at 1800, strong support, and we have resistance at approximately 1850. That is the 200-day moving average. A move above this price point would tell us that wave 5 is still intact in the subcount. A move towards the 100-day moving average would tell us that we've entered that ABC correction. Copper did decline today, now for the second consecutive day, currently fixed at $4.68 per pound after factoring in today's drop of approximately 5 cents on the day. However, you can see our entry price, which came in at $4.55 a pound, and my sense is as long as it holds approximately $4.62, which would be below these recent lows that came in before this big spike here, I believe what we are witnessing is simply consolidation, a little bit of profit taking, but realize that occurs after the all-time record high that was hit just 4 trading days ago when copper traded to $4.87 per pound. A huge move, a huge spike following a huge close that came in the day before. For that reason, I'm very comfortable with where we're at. We will look to raise our stops within either this week or the beginning of next week. However, we're out in a July contract, and I believe there is a lot more room to the upside as long as we don't have some sort of correction first. In that case, we would either take our stop to the market or quickly raise that stop. But for right now, I am still optimistic and extremely bullish on the long-term prospects in copper. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Have a great day. Bye-bye.